Well, the TSX closed up about 1.5%. We're just about 0.5% away from those all-time highs. It's been a while since I've said the TSX has hit an all-time high. We didn't really see it in the month of April. Amit Joshi is portfolio manager and Barometer Capital at Barometer Capital Management. And Amit, we have a chance maybe to get to these levels this week with earnings in focus. By and large, how would you characterize how the TSX earnings are coming through?
Hi, Amber. Yeah, really good question. Overall, I think the earnings season has been kind of as we'd expect. I think the biggest takeaway that we've had is just the price action in general to earnings beats themselves has felt a bit more muted, and a lot more attention has been given more so to the forward guidance. Not surprising, I guess, given where markets are trading and the high expectations that we are seeing from investors itself. So we've noticed where guidance has come in a bit disappointing or lower than consensus itself. We've seen a larger negative reaction to the earnings results themselves.
The rally, though, from the lows of mid-April has been interesting because it's really kind of swept maybe unlikely bedfellows, a big recovery in utilities, but tech is right there as the second best performing from those April lows. Materials, financials, sort of everything along for that ride. Talk to me about the strength that we're seeing in utilities because it's coming at a time where we've seen some pressure in the bond market.
Yeah, I think the utilities sector is interesting from the perspective of where bond yields are trading. You wouldn't likely attribute strength in the sector, but I think what we're seeing is maybe a stabilization in rates themselves, and that providing a bit of a floor to utilities themselves, and some investors looking for some attractive valuations to get involved.
Are you getting interested in some of those bond proxies like utilities, or you prefer kind of more risk-on cyclical sectors like energy?
Yeah, for us, we've been tilting our portfolio more towards energy than the utilities themselves. We just, from our perspective, see more upside in energy given the dividend growth aspects that they generally have versus the utilities themselves. And we just haven't, although the price action here has been constructive as of late, it just has not hit our overall technical and quantitative models themselves. For us, the energy sector screens a lot better at this point.
What's an example of a top holding or one of your favorite stocks in the energy sector?
Yeah, within the energy space, we continue to like Canadian Natural Resources. It's a bellwether company here in Canada in terms of an energy producer with long life, low decline assets, really strong management team, and a history of operational excellence. So that's a name that we've liked. Along with the rest of the oil and gas sector, I think COVID was a tough situation for all of these companies where there was a lot more emphasis put on the balance sheets and kind of cleaning them up and paying down debt. And we now have C&Q who've reached their net debt targets and are returning 100% of free cash flow to shareholders through dividend increases and share buybacks. That's a 5-year dividend CAGR on that stock of about 23%. So that's one that we feel is a good fit in our income mandates and one we continue to like.
I wonder if you're taking advantage of the recent pressure that we've seen in the industrials group, kind of held back by the rails, but then you see breakout. Thomson Reuters weirdly is an industrial. Stantec, I was just talking about SNC Lavalin hitting the highest level since 2018. We are seeing some of these, pockets, maybe they're not as influential in the sector, but managed to outperform.
Yeah, no, that's a great point, Amber. And I think those are, two names that we really like. Industrials as a sector has been a sector that we've liked for majority of the year. And, you hit on the head, Thomson Reuters, not your typical industrial company, but, one that plays in the information publishing and electronic solutions market. And their leading position in their two main segments of legal and tax accounting is really interesting. It's a company that provides a good mix of both stability and growth. They've had a very balanced approach to capital deployment. They're a dividend grower. They grow their dividend on a 10% CAGR, and they've also deployed over $2 billion in M&A since 2021. One of the focuses, and I think, part of the reason we've seen the stock perform so well is the investments around artificial intelligence and, the growth that we could see accelerate once customers start adopting that. Their legal and tax accounting businesses are those end markets are kind of ripe for efficiency gains from the likes of AI, just very labor intensive, and ones that could really benefit from AI. So that's a company that we continue to like for sure.
A lot of these charts are kind of up and to the right. I'm wondering if you've got any thoughts on a TD, which has gone a different trajectory, recently closing at a 3-year low, bounced a little bit from here. I guess I'm surprised that investors wouldn't flock to the opportunity to buy, a bank so cheap with a dividend yield that you don't historically get. I guess that's such a big shadow that's being cast by the AML issues.
Yeah, I think you're definitely right. It's the uncertainty that we have around those regulatory issues. We did own TD. We sold it on the back of the Q1 results. We thought the results themselves were weaker than peers, and we just couldn't get around the uncertainty from a regulatory perspective. I think putting the fines aside, there is a lot of investment that TD will need to make when it comes to, the AML department and the procedures around that, and that could be a multi-year investment that you have to make, as well as maybe restrictions on M&A in the U.S. itself. So we've shied away from that one. We continue to like the Canadian banks, but we'd be buyers of a national bank or CIBC, two banks that have more domestic exposure versus TD, and ones that are generating good operating leverage in comparison to the group. That's one thing that when we look at TD and the additional spend that we're probably going to see in terms of building out AML practices, we feel that operating leverage could be impacted further, and that's a metric that we keep a close eye on.